board, Harish Krishnan then. Harish, hi, good morning. Good to be speaking with you. Harish, how do you digest all the uncertainty with regards to news flow? Just when you thought it was all settled down with pharma tariffs and you were anticipating that there will be a trade deal finally with the US, and now you have this spanner in the works on pharma tariffs.
Right, you're right that the uncertainty level has just kept on creeping up. But the reality is that markets react to earnings, market broadly react to the competitiveness of companies and their future long-term prospects. And in that aspect, I think I want to call out two specific data points. First is over the course of the last 18 months, as you rightly set out, we've had multiple macro developments which have been concerning from the external front. But on the internal side, be it in terms of credit growth, be it in terms of overall nominal GDP growth coming through stronger this year compared to last year, where nominal GDP growth and real GDP growth was broadly along the same handle, or the fact that you've got a weaker currency, which in a way positively benefits the competitiveness of companies. So in that backdrop, when you look at two data points, which is the number of companies which were trading at 50 PE on a trailing basis among the top 500 companies used to be about 40 to 43% in 2024 mid. That has come down close to about 30%. So there has been some reduction in froth. Of course, pre-COVID, this number used to be about 20%. So there still is a elevated number of high valued companies in India, but it is moderated. The second aspect is the number of companies among the top 500, which are growing by 15 percentage points on a YOY basis, is now close to about 55%. This number used to be in the 30s about 18 months back. So therefore, it does appear that, as long as companies are doing the right things for their customers, they will get better appreciated by the marketplace. May not be immediately, but over a 3-5 year period, we definitely are constructive on equities from that aspect.
Harish, hi, morning. So, while everything seems a little, surrounded by uncertainty, which is a sector where you see some kind of growth coming in, or where the impact of that uncertainty is minimal?
So I would think that, asset owners is an area, especially on the regulated pack, that is an area where, be it on AI or be it on external front, the challenges there are quite minimal. So for example, airport operators, yes, in the near term, there is definitely some hit on the crude oil prices and therefore the impact on traffic. But from a medium term perspective, this seems to be in a very good space. Similarly, on the transmission side, I would think that that's again a space which is not so much impacted by various external developments. If you think on the regulated side, again, be it on sectors like, say, insurance or in terms of banking, where currently, of course, there is a lot of worry of regulatory overhangs, etc. The reality is that the competitive activity in that space is kind of reduced. And that, again, is an interesting area, if I may say so. Similarly, I would say auto anchs. That's a space wherein both in terms of the domestic auto cycle starting to look good, as well as from a perspective of taking significant market share gains from the rest of the world. In an environment where the Indian rupee has weakened by about 20 percentage points against the Chinese yuan. That's again an area which seems quite interesting. So all in all, I would say that there are more sectors which seem promising, even new age businesses for that matter. If you think about it, a lot of new age businesses, especially the market leaders, have significant head start over the number 2, number 3 players when it comes to the customer market share. But many of them are possibly not optimized on unit economic level. Their single largest cost is engineering talent. And with what's happening on the AI side, can the engineering talent kind of either inflate at a lower level or even kind of reduce? And that is where the unit economics for many new age businesses can kind of surprise on the positive. So we think that there are vast swathes of market where, we do think that there is a lot of interesting opportunities at this point of time.
Harish, interestingly, a third of all portfolio is financials and especially banks, which is there. And going into the earnings season, you had everyone weighing on private sector banks for growth. and the numbers which have come in is not so enthusing for many of them. Do you see that churn within your portfolio as well as asset manager, that the bet would be much in favor of PSU banks now?
No, so you're right that the last 2 years have continued for PSU banks' credit growth aggression being a lot higher than the private sector banks' credit growth aggression. Private sector banks' spends on technology have been far higher compared to the public sector banks. And the overall banking pack has been losing share to NBFCs, which used to be about 10-15% of overall credit growth maybe about 10 years back. That's now inched up close to about 25% of overall credit market. So there has been multiple areas where they have kind of taken share away from both from the PSU pack as well as from the NBFC side. Having said that, the fundamental aspect in our belief is that these companies, especially the well-run banks in India, can potentially double their profit pools every 5 to 6 years. And if that is available at, say, anywhere between 12 to 14 times earnings, we think that a lot of the goodness is not yet priced in, and therefore we continue with our stance on being selectively present as far as the banking space is concerned. We're equally present in NBFCs. We have some exposure in PSU, but beyond a point, we do get slightly bothered about the fact that growth continues to be very strong, and we haven't seen a asset quality cycle kind of come through. Not that I am saying that in the next 12 months we do think that the asset quality cycle is going to dramatically worsen, but anything where there has been uncheckered growth in the past typically hasn't led to a very great outcome for medium-term investors in that space. And that is where our broader stance as far as financials is concerned.
Makes a lot of sense, Harish. Hi, this is Harsh joining in as well. Give us a sense how you're looking at pharma, because, I mean, the overnight developments seem to suggest that it's long-term or medium-term. There is a risk to Indian pharma, but how realistic is this 100% tariff? How are you looking at everything that's played out overnight?
So you're right that I think a 2 year window where we don't even know whether the presidency is going to remain, it's going to be a completely new regime, and obviously bringing back production in US is likely to increase the cost in a sector where healthcare costs are possibly the single largest constituent anywhere in the world, especially in US. So I'm not so sure in a realistic sense we are going to see a significant move back into US in terms of production. More importantly, it will also reduce some of the competitive intensity. Today, every new molecule is seeing a significant amount of new players from India coming through. And possibly there is going to be some recalibration of where they want to which molecules they want to attack, and which is again positive from the medium term point of view. Having said that, we do think that, the opportunities in the domestic side as well as on the CDMO side are far more encouraging compared to the generic side of business, primarily because we think that there are some very large molecules which are going off the base. Close to about $1 billion of profit pool came through because of some one-off nature as far as the pharma profit pools are concerned. And that will take some time to kind of fill back in. And therefore, from that perspective, the next 12, 18 months from an earnings point of view, it doesn't look very strong from that construct. So overall, our view is more on the domestic side, where we have seen actually an improvement in the revenue traction over the course of the last quarter, as well as, hopefully over the course of the next year or so. Similarly, diagnostics is an area which saw significant competition during the COVID wave, wherein multiple new players came through. Even the unorganized space made so much of profits that they kind of sustained the fight for much longer. That's again an area which is kind of now the pricing power is coming back to the industry, and volume growth is kind of encouraging. So that's again an area which we think is a lot more positive upon.
Okay, and just last quick question with regard to the early returns have been made, right? There's been a bit of a value unwind which has happened. How much of value unwind still left thereafter? Where will earnings pick up be the strongest? If you can give us maybe a few sectors, pockets where you believe that value hasn't fully unwound after the recent correction. What could be opportunities? And thereafter, with regard to earnings, where could the pickup come from?
So I'll try a different take on this because,
Okay.
in my opinion, there are broadly about three subsectors or themes which are still very frothy. And while near-term earnings growth is still very strong, so in that sense, maybe they are frothy for a rightful reason. But where medium-term worries start to kind of concern us, they are primarily in capital markets where we've seen profit pool expansion significantly over the course of the last 5 years, attracting a lot of new players coming into the market and a lot of supply of paper coming into as far as the stock markets is concerned. The second area is defense. This is again an area where if you were to look at the total profit pools, they are currently at about 25,000 crores. The total market cap is close to about 12 lakh crores. This is something where a lot of positive things are happening. Don't get me wrong. I think the demand environment is still very, very strong. But this is where, if you look at it, the larger companies are no longer participating, be it in the defense PSUs. Over the course of the last 1 year, ever since Operation Sindoor, most of the defense PSU names are kind of, flatlining or have kind of underperformed. While we have seen a lot of small cap and micro cap companies raise a lot of capital, this to our mind is slightly concerning from a stock market point of view. The third area is on the T&D space and capital goods, where again, there is a data center story and there is a lot of activity. For sure, they are making supernormal margins. But a lot of these are peak revenue, peak margins, and peak multiples being ascribed. If I leave these three out of the picture, I would say that there is value in a whole range of other sectors, be that, like I said, in auto hangs, new age businesses, financials, even outsourcers, or on the consumer side, be it on the retailing side out there. In respect of where earnings can kind of surprise and inflect in the near term, I would say auto hangs would be one area. I would say consumer retailing is another area where things can kind of turn positively. And third would be consumer materials or building materials, where there can be share gains away from the unorganized space to the organized space. So this is the way we broadly think of markets, try and reduce our capital and risk into the frothy sectors while kind of having a diversified basket in many other sectors and in some great businesses in these sectors.
Well, thank you. Thank you so much, Harish. Really appreciate you coming in and giving us your time and giving us that perspective.